We will continue in this class 6, continue with what we've been doing. We'll start off like I've been starting all classes, a quick review of our prior materials. So you're building that, getting a strong template. So if you get a question like this in an interview, or if you're just talking to someone who said, hey, you took an investment class, can you help me? You'll know how to approach the topic. You'll get more and more confident. And then after we do the quick review, the prior material will continue where we left off. We got through duration, convexity, and credit. So we'll finish up fixed income with the UTSI. And then hopefully we'll get started and get through somewhat far through stocks. There we use the term bucks, B-U-C-S. And so today, I think we can probably get at least through beta today. Maybe we may not. We might even just barely scratch the surface on the overview. We'll see. But remember what we've been building so far. First, someone comes to you and says, I want to invest. So they want to build a portfolio. A portfolio is a collection of assets, including probably primarily securities that someone holds for some future purpose, some liability. 3 questions you ask them: why are you investing? Which we really focus there on the horizon. We can look at risk questionnaires and risk tolerance type of things as well. We ask them, what can you invest in? And there we want to be parsimonious. Parsimonious is we want to have enough asset classes so we can explain the risk that they are taking in the markets, but not more than that, because it's extra workload that's unnecessary. And then how are you going to do it? The focus of the class right after we get through exam 1. Do they want to do it themselves or hire someone? Do they have a strategic allocation? Do they want to be tactical? Are they going to be active? Are they going to be passive? And remember, active and passive can be on the asset classes, or it can be on the security level. Do you want to try to predict if stocks or bonds are going to do better, if large company stocks are going to do better than small company? Or you can be active on the security selection. So if you're buying large cap stocks, do you think Google would do better than Apple, or Alphabet would do better than Apple? So that's active or passive at the asset class level or at the security level. We then got into the 4 major asset classes: cash, bonds, stocks, and alternatives. We then talked about the difference between cash and bonds related to reinvestment risk and price or interest rate risk. We did a quick review of cash and cash equivalents. Remember, on each asset class, especially the sub-asset classes, we want to define the asset class, give any of its sub-asset classes, and then talk about the strategy. On cash, there's no sub-asset classes. It's something that we just hold if we think some opportunities are going to come up. Bonds, we talked about duration, convexity, and credit. Again, you want to define duration as your exposure to interest rates rising or falling. You want to give the sub-asset classes. For duration, it's short-term, intermediate term, and long-term. Under the definition, you would use that formula minus duration times the change in yield to see how sensitive a portfolio is to interest rates. And then the strategy: expect interest rates to fall, you want to lengthen duration. Expect interest rates to rise, you want to shorten duration. Convexity is that second order sensitivity of bond prices to changes in interest rates. There our focus is really on the change in the volatility of interest rates. The classes that we have are, and I gave you a formula on convexity that you could put in your answer. It's a little bit more lengthy formula. It starts with the minus duration times and change in yield, but it adds in that extra for convexity. The categories in convexity is you have positive convexity bonds and negative convexity bonds, and you want to define those. Negative convexity bonds are the ones that provide the borrower some option to pay off the debt early, and they'll do that when it's at the lender's worst time, the worst interest of the lender, best interest of the borrower. And then the strategy is you expect interest rates to become more volatile. You want to buy convexity, that is, buy bonds with high positive convexity, avoid those optional bonds, those bonds with embedded options that have negative convexity. You expect interest rates to become less volatile, then you sell convexity, which means you buy those bonds with the negative convexity. Why? So you can capture that higher starting yield. Credit, the categories there, we talked about high quality, including governments, medium quality, which is all those triple Bs, and then low quality, which is all the below investment grades, also known as junk bonds, high yield bonds. So I didn't define it. You define credit as the ability of the borrower to repay, or the probability of default or bankruptcy. A strategy is you expect the economy to get better. You want to move down in quality and capture those wider yields. If you expect the economy to go into recession or get worse, you want to go up in quality. In addition, if you expect a recession, you probably also want to move up in quality and lengthen duration. If you're expecting a strong economy and a good rebound, you probably want to shorten duration and probably move down in quality. So high yield, remember, we don't worry about duration with high yield. So if you're expecting a strong economic rebound coming out of recession, then high yield would be a great place. So that's where we've been so far. What we want to do is finish up the UTSI. So the U on bonds is really unique. This one is a little bit tricky, and this is one area where you might find quite a bit of disagreement with my views, but this, I still believe this, and the last debates I've seen on this, I think this is still accurate, but there are certainly some people that disagree with me. So we're looking at U.S. versus non-U.S. owned bonds, all right? Some students, get this really clear in your notes, some students get confused because we have U.S. versus non-U.S. under bonds. We also have it under stocks, but they are very, very different. And some students get mixed up and they put the wrong answer for both, or they give the same answer for both when they should be giving different answers. So here we're talking about non-U.S. bonds, and you notice I have the word currency added in there. Anytime you start talking about non-U.S. bonds, you're bringing in the concept of currencies. You now have an exposure to another country's currency. And currencies are so much more volatile than bonds are that when you buy non-U.S. bonds, the biggest thing you're picking up is currency risk more than anything else. So currency risk, as it says here, currency risk dominates all others. And so when you invest in non-U.S. bonds, you're essentially making a bet on their currency. So if you buy Japanese bonds, you're betting on the yen strengthening. If you buy UK bonds, you're betting on the UK pound strengthening. If you buy European bonds, you're betting on the euro strengthening versus the dollar. That's just the nature of it. And really, a currency will strengthen if that country's inflation does better than other countries' inflation, and or that company's interest rates do better or higher than other countries' interest rates. Now you have to be careful because interest rates go up with inflation. So higher inflation hurts currencies. Higher interest rates help currency unless the higher interest rates are because inflation is going up. So you have to be careful. It's a pretty complicated formula. But the key here is when you buy another bond of another country in their currency, you're making a bet that that country's relative inflation and relative interest rates will outperform the U.S. and the U.S. dollar. It's a very tough bet to make. I remember a fairly wealthy gentleman here in town in San Antonio. He was interested. He was from India. He's from India. And he saw that he could buy bonds in India yielding 11%, really high quality bank CD types of investments at 11%. He said, why wouldn't I do that? Interest rates in the U.S. are only 2 or 3%, but I can go to India and make 11%. And so I told him, well, but when you go to India and invest at 11%, you're also getting the Indian currency. And so if the Indian currency is expecting much higher inflation in India than in the United States. If the inflation in India ends up exactly like priced into that currency, you'll make 11% on the Indian bonds, but when you convert them back to US dollars, you'll lose so much on the currency that you'll end up with the same return you would have gotten if you just stayed in the United States. Now, if Indian inflation does better than that price when you bought those bonds, then when you convert that Indian currency back to US dollars, you'll have a big gain. But if Indian inflation does worse than what was priced when you bought the bond, then their currency is going to weaken, and when you convert it back to US dollars, you actually have a loss. So that's why I say it's a bet on the relative country's inflation. So the only reason India had much higher yields than the United States is because India inflation was much higher and was expected to stay much higher. So it's a pretty complicated bond to get into. Here's something if you want to do additional analysis. I think I mentioned this one earlier, but you can certainly go out there and look up the term currency overlay portfolio. We did some of that when I was at USAA. That's when you hire a bond manager who buys non-US bonds, but you also want them to manage the currencies. So they might think Japanese bonds are great, but the Japanese yen is terrible, so they'll buy Japanese bonds, but then they'll hedge out the yen risk and convert that back to euros or pounds or US dollar. That's a currency overlay portfolio. You could certainly look that up and you'd find all kinds of websites that would talk about firms that do that. Usually, if you're interested in currencies, and I've had some students say, wow, I'm really interested in currencies and trading non-US bonds, then that will definitely define what master's degree you get. You'll probably want a degree in economics, econometrics. Most, if not all, I can't think of any currency overlay managers who don't have a strong economics background. Many of them have a PhD in economics. They're economists. They're not finance people running these portfolios, because you really have to understand inflation, central bank policy, what the economy is doing. It's really, really important to understand that to be able to understand these bonds. Now, you could go in the lower quality bonds, like emerging country bonds. There, the currency risk is not as big as the credit risk, because these countries are on edge if they struggle. You know, South Africa, Venezuela, Argentina, those countries that are just have had really big struggles. Brazil, maybe right now, it's what's going on with COVID there. You know, there's just countries around the world that are really struggling, and so their bonds have really, really great yields. There's a good chance if that country does better than expected, the bonds will do better and the currency will do better, and you'll end up having a double gain. So if you want to bet on Argentina right now, as much struggle as they're having, or maybe Peru with all of their political upheaval going on, and maybe you think that's all going to work out well, or maybe Brazil's going to work out well. However, you're going to do it. You know, Brazil's worried about a new president coming in that's probably and probably going to really hound them about their burning down of the forest. Maybe put some constraints on that country, and you know, whatever. So maybe that's priced in the bond. Maybe you think it won't be that bad, and so you buy those bonds. So when you do lower quality bonds, those countries that are struggling, if you really think they're going to do better than expected, you'll have a double win. The bond will do well and the currency will do well, but you better know what you're talking about. Using emerging market bonds for most people are still under alternatives. They're not under, you know, as part of bonds. And for a lot of people too, even non-U.S. developed market bonds, those tend to be alternatives as well. We had one portfolio at USA. We had two portfolios at USA where non-U.S. bonds were part of our allocation. They weren't considered alternatives, and that had to do with just the nature of those. One was managing a book of business, because USAA did business overseas, and so it was essentially managing our currency risk overseas. Another one was part of the pension plan, and we figured having some currency allocation would help protect us from high inflation in the United States, because if we had high inflation in the United States, it probably mean that the dollar would weaken. And so we did that as because the pension plan had inflation risk. So then we had two portfolios. Most of our portfolios did not allocate to non-U.S. bonds. When I was at USAA, there was a discussion on the mutual fund side of starting a non-U.S. bond mutual fund. And the head of the fixed income side, a good friend of mine, he said, no, we're not going to do that, because people will see a high quality bond portfolio and think it's not very risky, and they're going to buy it, and they're going to be shocked at how volatile it is because of how much currency you have, risk you have. Now, there's ways, if you want to get into this, understanding currencies, you could have your whole career just on currencies. It could be a big career if you really like this. One of our investment society members, she is real heavy into to currencies. She really likes studying them. She has a strong background there. I'm not even sure if she's a finance major. She might actually be an economics major. But the terms you can pick you can look up or purchase. Well, I told you currency overlay portfolio is one. You can certainly look up purchasing power parity. Bloomberg has a function for that, or you can look it up on the internet. A simple power parity index is the Big Mac index. What purchasing power parity is saying is you should not be able to go over the border to another country, buy stuff there in their currency, bring it back to your country and sell it and make a gain. That should not be possible. So what the Economist is the one, the magazine, The Economist is the one that came up with the Big Mac Index. They did it once, several years ago. I think they did it somewhat tongue-in-cheek, think it was a little bit of a joke, but then actually people liked it. The reason they picked the Big Mac, I'm not sure that's so true today, but they picked the Big Mac because it was pretty ubiquitous. Most countries had a McDonald's. And I can definitely tell you that. I remember when I was in Rome, we were right across from the Pantheon. There was a, I don't know if it was a McDonald's, but it was a fast food store right next to the Pantheon. You know, you had this century old building, something you've seen, you know, in textbooks. And there's a McDonald's right across from it. So there's just McDonald's everywhere. When I go to Costa Rica, there's McDonald's everywhere. And a Big Mac is essentially the same in almost every country. There's a few countries, because of different cultures and different tastes, they may not use beef, they might use chicken instead or some substitute. But for the most part, it's the same product in every country. So the thought is, and I don't know where Canada is in here, if they even show it. Let's see if we can find Canada. I don't see it obviously in there. Oh, there it is. There's Canada. Okay, so let's look at this. Let's say you lived on the coast, on the border between Canada and the United States. So you could drive to Canada and essentially buy Big Mac in Canada for $5.08. And then you could drive back to the United States and sell that Big Mac, assuming someone would buy a Big Mac from someone off the streets. It's unlikely. But let's say you're a McDonald's owner. And so you run across to Canada. Let's say you're only 10 minutes away and the borders are open. They're not worried about COVID anymore. You run over there and buy 5,000, or let's say you sell 100 Big Macs a day or 200, whatever. You go over there and buy 200 Big Macs for $5.08. You drive back over to the United States. Now you'll buy with Canadian dollars, but once you do the conversion and buy Canadian dollars, it would be like you bought the Big Mac for $5.08. You go back to the United States and you can sell them for $5.71. So you would make a gain. And purchasing power parity said that should not happen. Now, if you really get crazy, you could buy 2,000 Big Macs in the United States and fly to Switzerland, and you make $1.20 on each one of them. So if you buy 2,000 of them, you'd make $2,400. It would probably cover your airfare. I doubt you'll be able to sell them. The biggest case is you go to South Africa, which is obviously struggling right now after Zuma and a new president and all the things that are going on there. It's a challenging time, and so if you flew to South Africa and bought 1,000 Big Macs, you could buy them for $1.86. Then you could fly over to Switzerland, sell them for $6.91. So obviously you couldn't do that because they're going to spoil on the plane. The plane probably won't let you carry 1,000 Big Macs on the plane. But that's the theory, is they should all be the same. They shouldn't have different prices. And obviously there are some products like shirts and shoes and those kind of things that you might be able to buy in one currency and sell back in your country in another currency. Now you got to be careful to bet on purchasing power parity. You know, to sell the Swiss franc and buy the US dollar, because the Swiss franc is almost always expensive. And it just has to do with interest rates in Switzerland and just the way it's viewed. So you might be waiting decades before these two get back into balance. Now the US used to be much, much further down the list. So there's good old Costa Rica. So if I go to Costa Rica, Big Macs are going to seem cheap there versus in the United States. Look at how far down China is. You know, we were complaining, U.S. was complaining that the China yuan, the China currency, was overvalued, and now you can see the U.S. has definitely caught up. The U.S. dollar is very, very strong right now. this might be a good time to bet against the US dollar because it's rare that US dollar is this high on the list. I'm not making any investment recommendations. So see, the Big Mac is just a simple way of measuring that purchasing power parity to see if there's a differential between the countries. The same product should have the same price in different countries once you adjust for the currency differential. And if you could make a gain on that product by just moving between countries, the currencies are mispriced. So that's currency, dangerous play unless you have a strong background in economics. The next one is the T. T for taxes. So where you want to talk about here is define it first. And you define it first by giving the categories. The categories are very simple. There's taxable bonds and there's tax-free bonds. Most bonds are taxable, but the United States, it allows municipal bonds to be tax-free at the U.S. level and sometimes at the state level as well. Obviously in Texas, municipal bonds are not tax deductible because we don't have a state income tax. But in states like Texas and Florida and California, they have state income taxes. They have municipal bonds that are tax-free. Usually at the state level, you have to have a California municipal to get it be tax-free at the California income tax level. So I won't debate whether or not it makes sense for municipals to be tax-free or not. There's been some studies that say it would actually be better if they were not tax-free, that the savings cities and municipals are getting by having their bonds be tax-free is less than what it's costing the U.S. government to provide this tax advantage. So it would be better if the U.S. government just taxed everything the same and then just sent that tax savings or that extra tax down to the municipals and states, and everybody would be better off. But that's a debate. You can read those studies. But that's the case right now, and it's certainly true right now. Municipals are not just state governments. They can be hospital districts and some other things. But things that are defined by law, by the federal tax law, as being free of tax, and they're always free of tax. So if you buy them, whatever yield you get, that's always free of tax. Unless you sell them and get a capital gains, then the capital gain can be taxable. So how do you choose between taxable bonds and tax-free bonds? I had another professor at UTSA. She got real upset with me for doing this. She did it by the textbook approach. The textbook approach makes more sense to me, but that's not how it's done in practice. I'm going to show you how it's done in practice. Now, if I were doing this, if I were to set this up, I would take the taxable bond and then multiply its yield. Let's say it's 5%. I would take its yield and multiply it by 1 minus my tax rate. So if the taxable bond is, say, 5% and my tax rate is 20%, I would take the 5% times 1 minus 0.2, or 5% times 0.8, and that would give me 4%. So the tax-adjusted yield on that is 4%, and then I would compare that to the tax-free bonds yield. That's not how it's done in practice. In practice, what we do is we take the tax-exempt yield and divide by 1 minus the tax rate. We essentially gross up the tax-exempt yield to be able to compare it to the taxable bond yield. I agree, it does not make sense, but it's just the way it's done in practice, probably because it's the tax-free municipal bond investors that are doing the calculation, and they'd like to have a higher number to compare to. So let me just give an example. The numbers in the yellow are what's in your class notes. These numbers here over on the side were the most recent numbers as of January 5th, so they're a little bit old by the time you'll watch this. But I took a taxable fund and a tax-exempt bond fund. The taxable bond fund was yielding 3.27. The tax-exempt was yielding 2.82. Let's say our marginal tax rate is 25%. You always want to use the marginal tax rate. On the exam question, I might give you both the marginal and the effective, but this is a marginal decision. What do you do with your next dollar of investing? So you always use the marginal tax rate. So the tax equivalent yield is 0.0282, that yield, divided by 1 minus 0.25, and that gives us 3.76. Because 3.76 tax equivalent yield on the tax-exempt fund is higher than the yield on the taxable bond fund, you would put your money, skew more of your money toward the tax-exempt fund. Now that's assuming they're the same duration and same credit quality. If one was long-term and one is short-term, that may not work, right? Because you got to make sure they're both intermediate. You want to make sure they're both about the same credit quality. So that's what I did here. These two mutual funds are very, very, very similar. Now, I did the same thing as of 1.5. You can see how interest rates have fallen since the time I picked these numbers up. So at that time, it was 296 and 274. You take 2.74 and divide it by 1 minus 0.25, and you get 365. That's much, much higher than the 296. And this has been true for some time, where tax-exempt bond funds just look like a really good deal now versus comparable corporate bonds. And the reason for that, I think, is what's just going on with COVID-19 and the stress it's causing for states and local governments. It's just a tough time to be a municipal. But these bonds these funds have done well, and they've actually done pretty well in the last few years. You can see both these funds have done well. Their yields have fallen. Remember, when interest rates fall, bond prices go up, so you would have actually done pretty well with these funds. But that's the way it looks. So just you define it as that some bonds are taxed, some are not taxed. So in defining it, that municipal bonds are tax-free, you're giving the two categories. So your definition and the two categories are all the same thing. Part of your definition should be this formula. And then how do you make your decision? What's your strategy? Well, your strategy is going to be compare the taxable bond fund to the tax equivalent yield of the tax-exempt bond fund. And whichever is higher, that's where you want to put your money. So pretty straightforward. Now we'll move to the coolest one of all, but we don't have much time to spend on this. If you find this interesting, then definitely take John Toohey's, Professor Toohey's fixed income class next fall. Highly, highly recommend it because he'll get into structured debt. So S is for structure. So, you know, if we looked in the books written on fixed income, sometimes as much as half of the book is on structured debt. And we've already talked some about structured debt. We talked about mortgage-backed securities, asset-backed securities. That's all structured debt. The term financial engineering used to be a good word. Now it's considered a bad word because of what happened in 2008. But a lot of PhDs in math have gotten into finance, especially on the fixed income side, working with bonds to create whole new securities. And the way they do it is they take a bunch of assets or a bunch of securities and they mix them up in different ways to give different types of securities. So a CLO is a mortgage-backed security. A CLO is a collateralized leverage obligation. It's a collection of bank debt that's been collateralized. A PAC is a mortgage-backed security. An IO and PO, those are mortgage-backed securities. A CDO is a lot like a CLO. It's collateralized debt obligation. It's a debt of banks. CMBS is collateralized commercial mortgage-backed securities. It's just like mortgage-backed securities except for commercial side, for mortgages to businesses. So CLOs and CDOs, that's banks taking debt other than mortgages and credit cards and auto loans, kind of all their other debt, and packaging them together. And then some of them come up with a great idea of creating a CDO squared. And what that is, it's a bunch of CDOs all in one CDO, which is a very complicated security because to understand a collateralized debt obligation, you would have to look through the trust and see all the individual loans that are in there. That's the only way you're going to assess that CDO. Well, CDO squared is a bunch of CDOs all in one CDO, so it's just going to be almost impossible to wrap your hands around it. Some people say they're a better security because you get more diversification. Most would say it's a scarier security because you have a tough time really figuring out what risk you are taking. CMBS really got mispriced in 2008. There's a group at UTSA that said, hey, let's all get together, pool our money, and let's buy a bunch of these because they fell a bunch in 2008 because of what was going on in the subprime mortgage market, but they didn't really deserve to fall as much as they did. And boy, I wish I jumped in with that group. I don't think they ever got it together, but these things were up, 70-80% in 2008, just dramatic. A PAC, IO, and PO. A PAC is a kind of preferred class of mortgage-backed. We talked about with mortgage-backs, you're really worried about getting that prepayment when interest rates fall. So the pack is set up so that you're protected from some of that prepayment. They take some of that prepayment risk and they shuffle it off to IOs and POs. An IO is an interest-only structured debt where they're taking mortgage-backed securities, but all you're getting is the interest payments. So you can get destroyed if that thing prepays, because if it prepays and refinances, there's no more interest. And then principal-only mortgage-backed securities. And I bring these up just to show you how incredibly complex, and there's a lot more than just this. It's pretty amazing what finance has created. And so what they do is they create these things called tranches. You could certainly look up financial engineering, structured debt, and you'll see, if you look up structured debt in Wikipedia, you'll probably see the word tranches. So the tranches, what that is they take a bond and they carve it up into different pieces and different tranches. And so if you want a high quality one with a low yield, you go into that tranche. If you want a low quality one with a much higher yield, you go into that one. So it's a way to take a bond and create 20 bonds for all different type of investors. It's definitely beyond the scope of this class, but it's a place where, again, where you could definitely specialize. I know the people at UTSA, they're the CMBS specialists. Boy, they know that market backwards and forwards. They'll have no trouble getting jobs whenever they want them, if they want to move around, get a higher pay, because they have a deep knowledge of a part of the bond market. That's a big part of the bond market. And that knowledge is just hard to get because not many people have that deep knowledge. But what you need to know is these bonds tend to be more complex, tend to be less liquid, so they'll provide a slightly higher spread. Even though they may be the same quality as something else, there's so much involved. They're much more difficult to analyze because you're not just analyzing one thing. You're not analyzing just, if you loan money to IBM, all you have to do is analyze IBM. But if you do a CDO, you got to analyze the credit quality of every loan in that CDO. So they're much more complicated. So you get a slightly higher spread to compensate for the complexity and liquidity. Now these things are rated. So you might have a CDO that's rated BBB, and then you have a BBB bond with another entity. The CDO will probably have a higher yield to compensate you for that complexity and lack of liquidity. We call it a liquidity premium. So if you don't mind the illiquidity kills you in times like 2008 when markets freeze. The least liquid bonds tend to sell off the most, so they tend to be more complex and more volatile. So be ready, know what you're signing up to if you buy those type of bonds. All right, our very last part of DC cuts I is the inflation. So we have two categories here. We have nominal bonds and we have inflation protected bonds. Nominal bonds hate inflation because they're paying you this fixed rate. So think back into the 70s. Let's say you bought a 30-year treasury yielding 5%, and then suddenly inflation shoots up to 9 or 10%. You're making 5, inflation's 10, you're getting crushed. And so those bonds did really badly in the 70s. So in 2003, the U.S. government created a new bond, inflation-linked bonds. They're called TIPS. I can't remember what TIPS stands for, but TIPS, the U.S. Treasury issued them. And what they do is they provide a stated yield known as the real yield. The real yield is essentially the yield you can get on a bond minus inflation. So all bonds have real yields, but this bond actually has its real yield stated. Nominal bonds, you don't know what the real yield is. You have to kind of guess what it is, back into it by subtracting inflation. And you can't just subtract historical inflation. You have to subtract inflation that's expected going forward. But the wonderful thing about these new bonds is we now know what the real yield of interest in the United States is, because that's what these bonds pay. They pay the real yield, and then once a year, they add whatever inflation was for that year, they add that to the principal of the bond. And so essentially you're getting a stated real yield plus you're getting inflation added to your principal. Now you have to be careful because that can go negative. Inflation can be negative, so you can lose some of that. The wonderful thing about these bonds is we now have great insight into the bond market and what it believes about inflation. Now, if you're one of those students who wants to be incredibly successful in finance and you're interested in the investment side, I highly recommend you go watch my YouTubes on bootstrapping the yield curve. A lot of students do that for paper 3. So when you get to paper 3, bootstrapping the yield curve is one way you can come up with your risk-free rate. I think it's a powerful, powerful thing to learn. I forget how many videos, but it shows you how to bootstrap the yield curve, including bootstrapping inflation-linked bonds. And that way you can really not only tell where the bond market thinks interest rates are going, you can also tell where does the bond market think inflation will be in 5 years. It's a really powerful thing. So I'd recommend you learn it, because you might find in your first job, you're in a job that needs an inflation forecast, and your boss normally just goes to some, kind of whatever the average economist thinks, which tend to be really horrible forecasts. Apologies to my economist majors and professors, but economists tend to not be they don't have much skin in the game. If they're wrong, no one cares. If you go to the yield curve and use it, you've got someone who has skin in the game, people who have money invested, and you'll see what they think inflation would be. So you're in your first job and your boss is using consensus, and you say, hey, what if I bootstrap the yield curve and tell you what the bond market thinks inflation is going to be? And he or she might look at you and say, what are you talking about? And now you look like a genius. So, those are the things that you learn. They're quite powerful. I always tell the story because I remember this from UTSA. Sitting at my desk, not bothering anyone. I was in my office, just doing my job, and the phone rings. It's coming from a conference room. I'm thinking, why is someone calling me from the conference room? I pick up the phone. It's the CEO of UTSA. He goes, Ron, I'm in this room with all these accountants and finance people, and none of them know how to bootstrap the yield curve. Can you do that for us? And I had seen that on the CFA exam. I knew how to do it. I do it all the time in my job. So yeah, I can do that. Fortunately, I knew how to do it. He had me on speakerphone with all my peers. Fortunately, I knew how to do it. So these are these things that you learn. It kind of gives you a sense if finance is the right degree for you. I always tell students there's 2 reactions when I get into these kind of off-the-fly, kind of tangent discussions. Some students are like, I got to go learn this. What is he talking about? That's incredible. Those are students who pick the right major. Finance is the right major. There's some students is like, I don't know what he's talking about and I don't care. Finance might not be the right major. This is exciting stuff. So if you want to set yourself apart from the competition, then go out and look at that, how to bootstrap the yield curve. I got those YouTubes. If you can't find them, I'm pretty sure I'll put them in the notes. You can just look up the word bootstrap, B-O-O-T-S-T-R-A-P. Look that up in the notes and you will find it. All right, so that's inflation. I think what's interesting with tips, I was at an inflation conference, and at that conference, that's where I learned how to get the forward inflation rate, called the break-even inflation rate. And I found it interesting because the economist said that the Fed chairman, that time it was Bernanke, that was his #1 way of monitoring inflation. I think Janet Yellen is the same, and probably, it's probably been used by most Fed chairmen. I know Greenspan as well looked at it quite carefully. Because what Fed chairmen know is the bond market is extremely important. It sets interest rates, and it sets interest rates based on inflation expectations. And inflation is both an actual thing, and it's also a psychological thing. That when people start thinking about inflation, it causes inflation, because when people are worried about inflation, they buy stuff faster, which causes inflation to rise faster, and it becomes this kind of self-fulfilling prophecy and kind of a spiraling effect. And so when the Fed sees that the bond market is worried about inflation, they know they're going to have to act, because it's almost too late at that point. And so the break even, that forward inflation number, gives the Fed a very early indication of when the bond market's worried about inflation. So it's a really great technique to have. So yeah, I'm just giving you these little things to separate you from the pack when it comes to interviews. All right, so there's our fixed income. DC cuts I is a great acronym to keep. I would remember it 5, 10, 20 years from now. I actually went out and asked a student that had taken the class 5 years before, and I asked them, can you remember exam 1, and DC Cuts eye was the first thing he put down, off the top of his head without looking at his notes. So it's a good thing to keep. All right, so here's the 5-year forward. Look at my YouTubes. I'm not sure I have the YouTubes in there. You have to look and see in the notes. If they're not, I'll make them available to you. But if you expect inflation to be higher, so here we talk about strategy. You expect inflation to be higher. Inflation is higher than that. It's priced into the bond market. Then you would overweight tips. If you expect inflation to be tame or lower than that price in the bond market, then you don't want to buy tips. So the key is, what is the bond market saying inflation is going to be? If your opinion is higher than that, buy tips. If your opinion is lower than that, don't buy tips. My YouTube show you how you can actually set up some trades where you can actually put a bet in place, and if you're right, you can make a lot of money. So what about stocks? Now we get into stocks. So my last job at USAA was Vice President of Equities. I should have been Vice President of Stocks. Why don't I like the word equities? Well, equities just means you have ownership. So you can have equity in your house. Real estate. If you buy real estate, you have equity in the real estate. So equities includes real estate, includes anything else you can own. Includes commodities, includes a lot of things, includes timber, all these alternative asset classes. So equities is the big category and stocks is a subclass of equities. So stocks, I think, is the better term. Equity sounds cooler, though. I mean, it did sound cooler for me to be Vice President of Equities and not Vice President of Stocks. I agree, it's a better title. But as a stockholder, you are a residual owner of a publicly traded business. By residual owners, that means you get all the assets of the firm after they pay off all the bondholders and other creditors. You have unlimited upside. You can make all the money you know. If that stock keeps going up, you keep making money. That's very different than bonds, right? Bonds don't have the upside. You buy a bond, the most you're going to make is that coupon you get off of the bond. You can't get anything more than that. But with stocks, you have unlimited upside, but you have limited downside. The most you can lose is 100%. Now you might say, well, duh, of course. Well, that's absolutely not so obvious. In fact, some people think one of the biggest reasons why capitalism has made us so wealthy, the entire world, it's interesting, the poorest 25% of American and U.S. citizens today are richer than the top 1% of U.S. citizens were in 1870. It's pretty amazing. We've never seen that kind of wealth increase where the poorest people in the country are richer than the richest people in the country were just 150 years earlier. We've never seen that kind of change in living standards. Some people think limited liability corporations is a big part of that because it gives people more confidence to invest in businesses, hire workers, grow their business. If they know the most they can lose is 100%, they're willing to take chances. And that's the same downside risk that the bondholder has, right? The bondholder can lose 100%. Now, they're in line ahead of the stockholders, so they're less likely to lose 100%. But the stocks is a wonderful thing that you have unlimited upside. You can make 40,000%. We saw Zoom this last year up several 100%, but the most you could have lost was 100%. Think about it in terms of, you're trying to find the next Microsoft or the next Alphabet or the next Amazon. So you buy 20 companies you think will take off, and 19 of them go insolvent. And you lose 100% on 19 of your businesses, but one of them's the next Microsoft. You'll still make a fortune. You'll make so much money on Microsoft that losing 100% on the other 19 doesn't hurt you all that much. You won't be happy you lost 100% on the other 19, but you'll be making so much money. You lose 100% on 19, that's 1,900, but you make 40,000% on that one other one. Yeah, you'll be making a lot of money. And so limited liability might be a big driver of innovation and growth in the modern world. There are people who do not like limited liability, and there are some entities that don't have limited liability. If you've ever heard the Lloyd's of London, if you invest there and they have losses, they can actually come back to you and say you have to put more money in. So you can actually lose more than 100% of your money because you are on the hook for bailing them out if something goes wrong. Now with stocks, it's very, very important to understand what a stock is and what the expected return on the stock is. Very simple formula. You'll use this formula when you do paper 4 and paper 3, really paper 3 more than paper 4, coming up with your discount rate for your stock. Stocks should give you their current dividend yield. The dividend yield is just the percentage that they're returning to you in dividends. So dividend yields today are around 1.5% to 2%, depending on the type of stock. Some are as high as 3 or 3.5%. But the S&P 500, the stock market is like at 1.7, 1.8% dividend yield, plus expected earnings growth. Now you also have repricing. We tend to ignore repricing because it's very speculative. We don't know if the stock market's overpriced or underpriced. Obviously, if you think the stock market's overpriced, you just don't buy stocks. If you think it's underpriced, you buy a lot of stocks. But it's hard. You know, people don't always get that right, or they may be right, but be 3 years early. It's a really tough thing to do. We know the U.S. stock market, I don't know what it's going to have done by the time you watch this video versus the time I actually recorded it. But at the time of recording this, the S&P just hit another record. The S&P 500 just hit another record high. Stocks are doing great, but they're doing great coming out of the COVID. It's pretty amazing how well stocks did coming out of COVID-19, doing a whole lot better than the economy and definitely better than Main Street and the typical worker. Could it have a big blow up? It could. But as far as we know, we should get a dividend yield plus expected earnings growth. So you need to have that in your answer. So we can see his next chart. I've always heard that stocks giving dividend yield plus earnings growth. So I decided to actually graph that. You notice I don't have the 2020 COVID in there. So I left that out just because it's so distorting. I might add it in and show you this chart again when we get to paper 3. We'll see. Part of my problem is I don't have good data to update this as far as I want to, but by the time we get to paper 3, I'll probably have all of 2020 data and can probably update this through the end of 2020. This only goes through the first few months of 2020. So it's a log normal chart just so you can, so a 10% change looks the same no matter where you are. And what I did with the red line is I took each decade's dividend yield plus earnings growth. That's what each one of these lines are. You can see a fairly regular slope from 1895 through 2010, a very stable slope. Very common dividend yield, very common earnings growth. And then you get to this last century and you just don't see much growth there. Why? Because the dividend yield is down and earnings fell so much in 2008. But each decade is like that. And then the blue line is the actual return on the stock market. And what I'm arguing is these two lines should be fairly similar. And for most of our history, they were. In the 80s and 90s, they got ahead of the line. Then you had the 2000.com bust. It's still ahead of the line. Then you had the 2008 crisis. It came back down to the line. But since then, the stock market has just been taking off. So either the stock market's mispriced or there's something else going on. I think part of this might be that risk is much lower today than it was in the past. So there might be a one-time adjustment to reflect that stocks may not be as risky as they were in the past. That doesn't mean this red line is wrong going forward. It just means we had a one-time adjustment, and then going forward, they will move together. But I just want to prove that point, that stocks do give you a dividend yield plus earnings growth for the most part, except for a few places in the 20s, the roaring 20s it got away. In the 80s and 90s, it got ahead of itself, and then right now we're in a period of time where it's getting ahead of itself. So where do we get expected earnings growth? Well, expected earnings growth is a function of the growth in the economy. Corporate earnings are actually grown in line and actually a little bit more slowly than the U.S. economy. Let me just show this to you. So the green line is a nominal growth. That means it includes inflation, the nominal growth of our economy. You can see here I do have the COVID in there. You can see the huge drop due to COVID. We haven't seen a drop like that since 2008, and even then this was a faster drop than then. Huge drop in our economy, but a big comeback. You can see in 2008 we didn't see the big sharp rebound, but we're seeing a really sharp rebound so far. We'll see with the next GDP numbers given the second kind of phase of COVID-19 and the lockdown. So our economy has grown about 6.41%. The red line is corporate earnings. Here you can see the huge drop in corporate earnings in 2008. Now most of that is due to banks and the fair value accounting, and that's the reason it shot back up. I saw firms that were writing off billions of dollars because of fair value accounting. We did not have fair value accounting back here. So fair value accounting, and a lot of people were complaining in 2008 that fair value accounting was making things look much worse, but earnings just essentially dropped almost to zero. But they rebounded really quickly because of fair value accounting as well. We wrote off bonds in 2008, and then they came right back in 2009. You can see the COVID-19 impact, but corporate earnings have grown only about 6%. You might think, wow, corporate earnings should grow faster than the economy, but they actually grow slightly slower than the economy. And part of the reason for that is my corporate earnings is the S&P 500, and a big chunk of our earnings of our economic growth are these small companies that don't even exist yet, like Facebook that didn't exist years ago. And there's companies that don't exist yet that are going to be huge. And so a large part of our economic growth is going to be companies that aren't in the actual benchmarks I'm using to come up with the red line. But I do want to show you there's definitely a relationship. You see a dip in the economy, you see a big dip. The other thing I'm going to show you, I have two lines here, a 5% growth and the yield on 10-year treasuries. The reason I did that is there's a famous professor at New York Stern School of Business. He says corporate earnings growth should mirror the yield on 10-year treasuries. Right now, that's probably not too true since 10-year treasuries are only about 1%. But long term, if you look at that blue line, you can see it does have a pretty good relationship, at least to the top part of our earnings growth. And so, yeah, so this is an average. It's kind of hard to understand why the 599 is higher than the 572 when it's lower here. But I'm not sure. I may not have updated this number off the peak, either one of these. I might not have the COVID-19 in there. I wanted to give you a longer term number that wasn't so distorted. But anyway, you can see there's definitely a relation there. And so if you think the economy is going to grow 5 or 6%, that's going to give you a pretty good sense of how fast corporate earnings growth would be. So historically, stocks have had a really high yield, like 4%. Today, it's less than 2%. And earnings growth, as I just showed you, has been about 6%. So historically, stocks have given us about a 10% return. Now going forward, the dividend yield is going to be much, much slower. And economic growth will be lucky to get us to 5%. So you expect maybe, now let me show you where economic growth comes from. It comes from productivity growth, probably the most important piece, labor growth, and inflation. So productivity, maybe about 2%. I'll show you where I got that. Labor growth, maybe 1% if we have some immigration reform. We start letting more immigration happen in the United States. Otherwise, we're in trouble because the baby boomers are all retiring and we're going to have actual labor shrinkage. And maybe 2% inflation. So our economy can grow about 5%. Now, you might be thinking, wow, that's a really high number. Remember, this is nominal economic growth. It includes inflation. The GDP numbers you see recorded in the press is only real growth, which is productivity plus labor growth. So you've been seeing our economy has been struggling to hit 3%. We've been growing only about 2.5%, 3%, if even that. So that's on a real basis. You add inflation to that because stocks give you a nominal growth. You want inflation in there. Stocks actually help protect you from inflation a little bit because as inflation goes up, corporate earnings go up. So we want a nominal number. So that 5%, I think, is probably on the high end. It's lower than what historical economic growth has been. 6.5% is what economic growth has been, and I'm producing 5%. But inflation has been much higher in the past, and labor growth is expected to slow down. Productivity is a function of innovation, education, immigration, government regulations. So you can, and I'll show you this next class, we'll get there. I want to show you a few things related to that. So we'll come back to that. There's cultural issues. There's some books I do highly recommend related to that I'll show you. The last thing we'll do in this class, so we won't get into the bucks, the BUCS on stocks this class, but I love giving students a historical perspective. I think we fail really badly in undergraduate of not giving you a longer term history so you can have a perspective on the numbers you're seeing today. So I went back decade by decade and I showed productivity in the blue, labor growth in the red or maroon, whatever that is, and inflation in the purple. And productivity, you can see it's been ranging generally between 1.5% to 3%. Really slow in the 80s, recovered in the 90s, recovered in the 2000s. It's been really slow this last decade, from 2000 through 2020. This is through second quarter 2020, so it's really before COVID has really taken off. I remember reading The Economist, the very end of President Obama's administration, and he actually wrote an article for The Economist talking about where he saw things going from there, and he said his biggest concern was productivity. Why is productivity so slow in the United States? And it's not just in the US, you see it in other countries like the UK and Europe. And some people are pretty amazed, how can we have such slow productivity when we have all this artificial intelligence, we have computers, the internet, all this digital stuff? How can productivity be so weak? But it has been really weak this last 10 years. Inflation employment growth has been 1% to 2%, but you can see the last decade from 2000 to 2010, it was actually negative. The only decade where we had fewer jobs at the end of the decade than at the beginning. And that's because we built up so many jobs in the 90s for tech, and we built up so many jobs in the 2000s for banking and construction and building houses, and all those jobs disappeared in the 2008 crisis. We've had really good labor growth since then. Again, this is through second quarter, so it includes the pandemic, but we've had strong labor growth since then. Inflation's been lower than historically average, more like 1.5% versus the typical 2%. So there's the medians. So, that's why I say that 5%. You look at the last decade, we've only gotten 4%. And you can see the last 2 decades, we haven't even gotten 5%. The other decades, we got 5%, but that's because of really high inflation. Productivity growth and labor growth has been much stronger in the past. So the 90s was pretty strong. We had 4% productivity plus labor growth. So there's the last time we got the 6%, and it looked pretty healthy. In the 80s, we had much higher inflation in the 80s, so there it didn't look all that strong. So, the last 2 decades are a little worrisome. You can see productivity and labor growth offsetting each other. I'll get into this in more detail when we talk about paper 3 because you'll need this. But I'll come back to this. So the next part is bucks, but before we get into bucks, which is the first part of bucks is beta risk, I want to spend a little bit of time here talking about productivity and just giving you some ideas on things you can look into there and do some additional research.